you're thinking of wealth building as like, shooting out into space and then going zero gravity is what financial freedom is, right? But like part of this is cutting through the atmosphere and getting zero gravity, getting less friction in your way. It's not all about making higher returns. It's also about like less drag in your face. So if you can cut your taxes a little bit, you can get farther on less.
Today's conversation explores how real estate investors can stop gambling on appreciation and start building durable, cash-flowing properties using assets designed for real long-term demand, not hype. Hey everyone, welcome back to the Freedom Blueprint. I'm Adrienne Green, and today we're here with Lane Kawaoka. Get ready for insights to help you create more freedom with your investing. Let's jump in. Lane, to ground everyone quickly, can you walk us through your current investing focus today and how your portfolio's evolved from single-family rentals to passive investments?
Yeah, today we focus on commercial real estate, namely apartment buildings, mostly in the more B plus to A sector. Definitely not luxury builds because we still like the workforce housing sector because of many reasons, including the rich are getting richer and the poor are getting poorer. And, we like to kind of focus on that lower middle class, which we think is getting bigger.
Right. So there's a lot to unpack there. I'm excited for you to share more insights into all of this. Now, I understand you started with these rentals. Now you've got these passive investments, these apartment buildings. You've been very intentional, I believe, about focusing on cash flow over appreciation. What clicked for you in that, and how did that decision change how you built your business?
Yeah, I mean, when I first started, I was buying little turnkey rentals back in 2012 to 2015. So that was kind of where I got the hang of it in the beginning. I just thought it was cool that I was just creating more and more income to buy more and more properties. But, later on, we start like everybody else buying little crappy Class C 50-unit apartment buildings. We kind of graduated away from there. There's a lot of deferred maintenance items that you just can't predict, right? When a lot of these 1950, 1960 properties or older. So this is kind of where, taxes, insurance went up after 2020 and to really be able to make money and stay in the game, you really need a more than a buy, hope, and pray strategy or cash flow strategy. You need to create value, right? So renovating units, bumping the rents. It's just unfortunate that today you can't just, me in my 20s, you can't just buy a little rental property and cash flow on that thing anymore.
Right. And so you've been able to evolve, which one of the things I love about real estate investing is the different strategies for different investors. So you've evolved your strategy with the market. You found something that is a good fit for you. So let's talk about what that looks like. So how do you personally evaluate whether an investment is a good fit for you and for your buy box right now?
I mean, this is going to sound really boring. I've kind of taken this from more the institutional buyers out there. We have our spreadsheet, our analyzer, which is, there's a lot of them out there. They're all pretty much the same. They all have generally 50 to 100 different inputs, right? You put in the P&L statement, you put in where you think that you're going to be able to bump the rents up, you put in your reversion cap rate, you put in your escalators and when you think the rents are going to increase every year. You're not going to bump the rents up in the first couple of years. It's going to take a little while for it to ramp up. You factor that in. You see what you're going to make, projected what you're going to make, right? And then if you don't hit a certain threshold, you don't pull on the deal. That we have a certain criteria. We try to aim for a 2x equity multiplier by the end of the deal, just to baseline it against other properties, though we try to underwrite these properties the same way, the same set of assumptions, right? So like when I look about a bunch of deals out there, that's the first thing I'm going to do, whether it's my deal or somebody else's. I'm going to baseline the set of assumptions. And, because some people, everybody goes on that website, they get their little single family home analyzer and, you show that the rents go up 5% every month. That's very audacious, in my opinion. That's just going to make that up to the right hockey stick graph that everybody likes to see. But that's not realistic assumptions. In multifamily investing, there are maybe 4 or 5 very important assumptions that I think kind of drive the model. And if people are 80-20, Pareto principle people out there, I think even passive investors need to know what these things are.
I love a lot of what you shared there. I'm a spreadsheet lover myself. I'm also a huge fan of the Pareto principle. I'm curious for people who are eyeing this apartment building investing, maybe they're newer to it. What do you think are those basic foundational assumptions for that that market?
Yeah, I mean, the first thing that, most operators are going to fudge out there is your reversion cap rate or exit cap rate, right? This is that one cell on the spreadsheet that is the wild guess what the heck the market is going to be in the future. Nobody knows what the market is going to be in the future. So you try to be conservative, and, everybody says the word conservative in their presentations. But from an industry standard point of view, you try to underwrite the deal where you're thinking that the property is going to be in a somewhat neutral to even worse market in the future. So a very aggressive operator that they're going to be investing in the future where there's improving market, right? That's what you don't want to see. But what the heck does that mean, right? So what you're looking for in a pitch deck, or if you have the underwriting spreadsheet, if you're underwriting it yourself, is you want to use a reversion cap rate, exit cap rate that is slightly higher than what your prevailing cap rate in the market today. So for example, don't quote me on this because these things move a little bit, right? And depends on what submarket you're working with and especially what kind of asset type you're working with. But let's just take Phoenix, Arizona, something that we've had some experience in ourselves, near your Class B multifamily asset. I'm not going to say what submarket is because that's going to throw things plus or minus 0.25% or 0.5%. Back in the heyday in 2022, 2023, in the peak of the market, you're buying properties out there, I think maybe high fours, low fives, five, let's call it 5%, right? Was a prevailing cap rate what these assets are sold at. Today, the market has reset. Today, that those assets are being bought for 6.5 and higher. So, if you're an operator using anything less than 5.5 reversion cap rate, you get killed on those types of assets. If you're buying a Class B multifamily Phoenix asset today, those things might be selling for 5.5 or 6. Let's just call it that, or let's just call it 6 for math's sake. I wouldn't really want to be using anything less than 6.5 on my spreadsheet. My underwriting,
Right.
It use that as a case. So now that we've bored everybody by this, there's a lot of people want to hear about motivation and more of those
That's
tangible
true.
things on a podcast. They don't want to hear about this, right?
I think people want a mix of both. I hope so, because I like to give them that, right? The motivation, the inspiration, the mindset, and then also like something they can walk away with that's concrete. I hope.
Yeah,
But let's
yeah.
switch and talk about that mindset. That was always next on my list. And so, as you moved from, a lot of people start with, like you were saying, the individual doors, these little long-term rentals often. And as you move from that active ownership, single family homes, let's say, into these syndications with these apartment buildings, I'm sure there were a lot of mindset shifts that did have to happen. You're not necessarily a solopreneur, right? You got to let go of control and have your team help out, right? Different boots on the ground because you're probably not in every market you're investing in. What did that look like for you? What kind of mindset shifts or strategy shifts did you have as you went from the single family to the apartment syndication?
Yeah, I mean, to go to the bigger stuff, the biggest thing you need is the KP license, or it's not really a license or a card, but you got to get experience to sign on these larger loans. So kind of the Fannie Mae, Freddie Mac experience. Unfortunately, it's kind of a chicken and egg thing. You need to be in a deal to get experience to do a deal. So it's really weird.
Right.
Right. So, and it's super frustrating. But then again, it is what it is. And that's the name of the game. So you have to get around other people doing these types of deals to bring you in as more of a junior partner. So you can get that experience in the eyes of the bank or the lender in this case. Even if you've done hundreds of properties, if you never gotten underwritten and put your KP or loan guarantor on one of these loans, they don't care. So that's the first thing. And that's something I realize is like you have to play nice with others and you have to get involved in other people's projects if you're kind of starting from scratch here. And another thing as far as mindset, like at least for myself and the successful people that kind of came up in 2015 to 2020, in that era is kind of when I graduated in a way. You got to be a little bit insane, right? The hardest part of this business is getting your first deal from a broker. I mean, yeah, you could send out yellow letters. Some people teach that. I just think that's nonsense. You're never going to you're not going to send a yellow letter to somebody who owns an apartment building to sell your apartment. I mean, it's just that stuff works on little individual residential non-sophisticated owners. But,
Mhm.
For somebody who knows what an LLC is, has one, and owns a 4-unit apartment complex, they're no dummy. They know that they probably should just go to a real estate broker and sell the asset
Right.
there. not off market, to some person who writes a yellow letter to them and finds them off market, builds a relationship on the kitchen table, right? That nonsense doesn't
Right.
really work in the commercial real estate world. So that creates it's a single source where you have to go through brokers, and the brokers control deal flow. And the broker's number one priority is that the deal closes so they can get their commission. Their
Right.
seller can be happy. So unfortunately in that situation, they want to work with people who have experience. And again, there's a chicken and egg thing. If you're new, you're going to have to keep buttering up these brokers, kissing their butt until they finally send you a property, which typically takes a year and a half to 2 years if you're lucky. And I say if you're lucky, I mean, looking back at the people who kind of started in that same time, maybe 1% to 2% of people were successful.
Mm-hmm. Right. Well, and Lane, I had many years on the residential real estate side working with investors as an agent. And I will say, guys, if you are listening, all the commercial brokers that I worked with, it's exactly like what Lane said. They want to know that deal is going to close. If somebody's new and they're just, I know there would be people who they took a class, right? They took a seminar about how to go talk to these brokers and find deals for the syndicators, right? To bring the syndicators these deals. And it's like, you're going to have a hard time getting a broker to actually bring this to give you a deal in that situation, right? Because like you said, you got to have a relationship. They got to know you're going to close. So listeners, listen to Lane. Thank you for sharing that. Now, you obviously have to delegate a lot within your role as a syndicator. So how do you decide which tasks or responsibilities you stay involved with versus delegating or outsourcing to someone else?
I think it's the same method for any business, right? Just speaking general business, right? You kind of open up shop, you have a repeatable business plan. In this case, we all know that people need a place to live, and, class B, C, A, multifamily works, right? So you don't have to really worry about that stuff in this sector. Unfortunately, when you're starting out, you have to do everything. You have to raise the capital, you have to find the deal, you have to, work with the brokers, you have to be the transaction manager, working with the bank and everything. And then you have to operate the dang thing after. In the beginning, you have to do everything, like I said. Luckily, you're probably starting off with smaller properties. This is where you kind of look for what's your affinity. Where's your skill sets work best? Some people are more the operator type. Some people are more the people. Like when you start to maybe get like a dozen deals done, or maybe even 5 or 6, you should kind of be figuring out what you're good at this point. I mean, I'm kind of getting to this point in life where I'm just like, all right, the heck with like trying to be skillful in everything. I need to be really
Right.
focusing on my strengths because I don't really have too much time on earth. Why mess around with things I'm not that great at? And I think that's where people struggle, who are especially type A people, right? They think that they can learn everything. Everything is learnable. Or if they just try harder, yeah, eventually, but people do run through walls. But I think you need to figure out what you are, what you're best at, and then also try to and kind of build your team around you of other partners who are better at those other things that you are not at. I've seen a lot of people make the mistake of they get married too early, get hitched with a partner that, and they don't even know what each other are good. They don't even know what they themselves are good at. So then they get into these partnerships, but they both do the same dang things, and those partnerships eventually break off because it's a defunct partnership. I mean, there's no personal relationships hurt in it, but it's just they both do the same dang thing. And when, we have a partnership where people do two of the same thing, one of them is not needed.
Right. That's a really good point. And we can often with partnerships, we value or notice the things that we do well. And so sometimes we can see a partner and be like, oh, wow, they're amazing because they're also really good at this. But like you said, we need to find that complementary skill set instead.
Yeah. And also sometimes, I mean, don't want to be mean or anything, but you could be one of those 98% of people who were never really going to be successful from the start, that you kind of subconsciously knew that. And to now make your chances go to 97%, you get hitched with another person right off the bat. So I don't know. Again, it's tough, right? Like if you know that you're not going to have a good success rate, which this isn't, then you try to hedge yourself in a way, and that might meaning get another partner. Or some people get like 8 different partners. It's crazy what people do, right?
Yeah, I've definitely run into those people that seem to have a lot of partners. So I feel you on that. Now, Lane, I'd love to talk about your asset class because you've talked about how you really focus on this affordable housing piece. I'd love to hear how that came about and how that works for you.
We've done on the lower end, the Class C stuff when we started. I can remember specifically, I think it was like 130 units. Not huge property, but in this one, like it was scary to even go there. Like we never went there after dark. It was actually kind of scary. We had like not the armed guards go around, but you pay for the little rent a cop to go over around there every so often, right? Like that type of property. But from a numbers perspective, the occupancy was full, 90, 100%, but the economic occupancy was always like 70% or less. So out of 10 people, you had like 3 people who just were deadbeats and just wouldn't pay. We
Right.
eventually sold that deal with it was a big win, but yeah, that just wasn't in my personality, right? Like it just so you kind of learn by doing. And then on the high end, the Class A stuff, I mean, you just kind of difficult to find pricing because now you're competing with the institutional players who want those cleaner assets. And then, a lot of some of these family offices want those cleaner assets too. Again, I don't blame them, right? Easier clientele, easier tenants, but your
Right.
margins aren't there from a cash flow standpoint. And then oftentimes you don't have the value add opportunity in those
Right.
things. So we kind of just fall in the middle. What can I say?
Right. So you've gone for that middle, that B class where you've got some value add. You have tenants who you're not going to have that same deadbeat percentage. So the numbers are just going to work out a lot better for you on both ends, right?
Here's the hard thing, right? Like whatever you do, high end, low end, middle of the road, like I think it's just getting harder and harder to make these deals pencil, right? Like I mean, when interest rates shot off in mid 2022, we stopped doing deals for like at least a year and a half, maybe even 2 years. Things just, I said the spreadsheet earlier. When you start to, assume that the rents go up just a standard 2% per year, and you're putting in like even today, like when I look at a lot of these deals, an operator might be saying they're putting in $10,000 of renovations to bump the rents up $100. That's just not. I mean, that's a fudge factor. They really can't bump those rents up. If you look across the country, rents are pretty stagnant. Some places it's like even like -%. I mean, you're still having a
Right.
lot of inventory come online. I mean, we're just in Phoenix 2 months
Hmm.
ago, and we usually stay in one of the units, and next door was an empty lot prior to this year, where it's a damn near Class A 200 unit apartment complex, and they're giving away 4 months of free rent as concessions. A lot of these, I mean, I think Phoenix is still going to be another 2 years until that stuff works its way through the marketplace. Other markets, I think tertiary markets are a little bit better today, and that it might change in 6 months, right? I don't know. But like
Right.
today, the tertiary markets are not the overbuilt markets like your Phoenix or Austin. So I
Hmm.
think they're kind of the first to be recovering in terms of rent growth. But yeah, I mean, look, I mean, you do a SWOT analysis on everything: strength, weaknesses, opportunity, threats. In terms of where when I was investing from 2009 to 2000 and up into the 2022 when everything changed, you had a nice tailwind of pretty much 0% interest rates. You
Right.
look at the Chatham financial curve and the CME financial, which everybody should have bookmarked here if you're a real estate investor. They're not predicting the Fed rate to come under 3% in the next decade. And I would agree with that. They've been known to be
Yeah.
wrong, but if you underwrite that in, you know, these multifamily deals don't really pencil. Of course, you try and find the outliers, right? But
Hmm.
I mean, it's no bueno. And so you have to go to more audacious business plans, or we've been even getting outside of real estate to buying businesses, that type of stuff
Right.
too.
If you're a real estate entrepreneur trying to scale while doing everything yourself, there's a better way. The Time and Freedom Starter Pack gives you the exact first steps to reclaim hours each week with real support, including what to hand off, where to start, and simple tools you can put into place right away. Download it for free at adriennegreen.com/starter pack. Now let's get back to the episode. Yeah, I mean, you're right. There was the environment, right, was pretty good for a while there in terms of real estate investing. And now we do have these higher interest rates. We've got cost of living issues, like you said, stagnant rent. It's tough, but you're still making some stuff work, right? You're still finding some stuff. We're starting 2026 here. Do you have any plans for 2026 or any other projections for how you're going to find those wins in this year? Is it diversifying outside of real estate? Is it going to these tertiary markets, or Or do you feel like you've got some competitive advantage in Phoenix or other markets that you'll be able to continue to take advantage of?
Yeah, no Phoenix in the normal way we used to do it. Those numbers just will not pencil. Again, tertiary markets because the new supply isn't outrageous, right? So you can kind of underwrite with a more standard 2%, 2.5% rent increase escalator there. Those deals will work. But your days of like 6, 7, 8% cash flow paid per quarter are gone. If you're looking for those aren't here. And the only reason why they
Yeah,
have it is because the operator is fudging their numbers to get it to show on paper. They just don't
right.
cash flow that much. I mean, because the delta between where the cap rates are and where the interest rates are, that delta is not there. That's where cash flow comes from. I do think that insurance came down. To give you some glimpse, we've seen our insurance come down slightly, right? I think we didn't have any major hurricanes in 2025 that maybe caused that.
Right.
I don't know how that black box works entirely, right? Insurance costs, but that was a nice win. But it's required us to go to different business plans. So like what I mean is, things that you really didn't need to do back in the heyday of 2020 to 2023 where rents were skyrocketing. One of that is low income conversions. In this case, you'll have a developer will build a property and they'll get some nice tax incentives on it for maybe about 10, 15 years. But their deal is they have to rent it out, maybe like 20% under the standard price, right? And it's different in every city, municipality, but if you kind of Google LURA, lure, lurk, and it's called different acronyms, but you have this restriction on the property. But after a certain amount of time, you can go through a legal process to get that removed. The key is you look for deals that aren't in, still bad areas. You look for that property that was, lower income in a nicer area, right? Like that's the ideal. That's where you actually start to even pull in data and underwrite it on its own accord. But in some of these cases, you can find properties where less than 10 years or less than 10, 20 years old. So more of a class A minus property. And the rents are maybe like $400 under market. The tricky part is to bumping those rents, right? Because you're going to have a lot of turnover with the tenants. But in some cases, that doesn't happen, right? A lot of these people, they know they have a sweet deal. And if you're improving the community, you keep the good ones and you phase in new ones, and then you value add the property that way, not through your traditional physical construction, a new flooring, new appliances, new paint job, etc., but more of this kind of, I guess it'd be more of a legal process to get the rent restrictions moved that way. I mean, sure, people have dozens of different ways they improve the income or decrease expenses, but this is kind of one fringe way we're kind of moving. And so that's, we got the tertiary deals that are kind of boring cash flow. You're not going to get the pops there. And if you wanted to be more in the sexier markets, this might be a strategy to play around with. And then, of course, have some lobster traps outside of real estate too.
Yeah, and I think that you're sharing the reality of what a lot of real estate investors are facing, right? Of having to find these creative ways, having to maybe hustle a little bit more and find these opportunities and diversify outside of real estate. Now, I understand you come from an engineering background, if the listeners couldn't already tell from how you're very analytical of approaching everything. Now, my understanding is you've helped a lot of professionals, right? The W-2 income utilize real estate investing as a wealth building strategy. What would you say people underestimate or really need to consider that they don't already think about in terms of this apartment passive investing?
Like a lot of people don't realize that they can get the tax benefits flowing to them. They see this as, them investing in kind of like a partnership or a stock in a way where, stock investing, you don't really get depreciation in that type of stuff. But in reality, when you're in a syndication, you are an equity holder. So you get your pro rata share of the depreciation and operating losses that come through the asset. And I think what really got me initially when I was moving from single family homes, like with single family, you can deduct the 27 long years, the property value, right? The improvement value. So, I think like the first property I bought was like $500,000 and I was able to deduct maybe $4,000 a year. right, off of that thing. So with the commercial properties, you can do cost segregations, which drastically increases that amount that you could squeeze out. A lot of times, the general rule of thumb is you can take 1/3 of the losses all in the first year. So if you kind of string your portfolio, which I think you should be diversifying into many, many deals. You kind of take that big first year pops and you kind of stick that into your pocket. Specifically, what that means is you take these passive losses and you keep them suspended on your 8582 form. And now with AI, you can just throw your tax return into there and ask, what's my suspended passive losses? Look at my 8582 form. Hint,
Right.
some people don't have that form, right? And sometimes the CPAs don't like to give it to you because then they know you're going to run away from them. You're easier to run away. That's what you can do with this as a syndication investor, and you start to stack up these passive losses. Now, this is where people play it differently, right? Like some people like to do real estate professional status to drive down their income even more, but then they get caught at the end when these deals finally exit. Right. I don't know if you
Right.
wanted me to go over like lazy 1031 exchange. Maybe you've talked about it in the past, but in these all these different strategies that
There are.
really open up. From what I've seen, when people get involved in this stuff, like they easily drop their tax rate by like 10%. Easily.
Right.
Some even drive it down to like a third or a quarter of what it used to be. And that's what wealth building is, right? If you're thinking of wealth building as like, shooting out into space and then going zero gravity is what financial freedom is, right? But like part of this is cutting through the atmosphere and getting zero gravity, getting less friction in your way. It's
Right.
not all about making higher returns. It's also about like less drag in your face, which is what taxes is. So if you can cut your taxes a little bit, you can get farther on less.
For sure. And what I love, what I always think about is, when you're able to cut those taxes those first few years, that's more money that instead of paying it to taxes, you can reinvest into real estate and just get that snowball going. Cause, you make a good point there. People like, yes, they want to go into space, they want to have zero gravity, financial freedom, but you don't get there overnight. Right. And
Yeah.
so I think
Yeah.
that's one thing you're sharing the reality of the time it takes to get there. And any improvement in that direction is something to be celebrated.
Yeah, I do want to say, like, outside of real estate, I think real estate is a long-term tax mitigation strategy. I kind of equate it to like, you go into the doctor's office, you're not in the best shape. They usually say, well, good diet, exercise, these hard things, right? Who wants to do those things? That's kind of like buying real estate, right? You go into good investments over a long year. They're not get rich quick schemes or anything like that. But you get your passive losses, so you lower your taxes. It takes a while though. So some people, they go into the doctor's office, they have like a blood pressure of like 240. I think that's high. And they're like, oh, geez, we got to get this guy, down. This is kind of like the guy who makes $800,000 a year at their day job, right? Like the real estate, unless you're doing rep status, you can't do anything about that high blood pressure. So there, used to be options that people would do that be like that statin drug to get your income down, like land conservation easements. Although that's kind of gone away. I think 3 years ago, people stopped doing that with the omnibus bill. But you got oil and gas now. That's always been around, right? The United States wants to get off foreign reliance of oil, which is maybe why they took over Venezuela. I don't know if that's true. Just fact check me on that one, right? But with oil and gas, you're able to take the income off of the ordinary income, high W-2, 1099 side. I'm not a CPA, not a tax lawyer, right? I mean, if people need a referral, let me know. But, this is where, we've gotten involved in oil and gas projects for those intangible drilling costs is what people want to Google on their own to do their own research. But
Mhm.
yeah, that's in combination, right? You start to get into this world. I think what multifamily real estate is, it's kind of like gateway drug into this world of alternative investments. I mean, I kind of went from cigarettes to the harder stuff myself, right? Like doing turnkey rentals back from 2009 to 2015. Then I did the multifamily stuff. And then now it gets me into this, world of oil and who would have known that I have, in 2019, I started investing in oil and in Texas, not Oklahoma. I think Oklahoma is a little bit more environmentally difficult, but like in Texas was my first one. Then you get into the world of angel investing and all these more asymmetric, riskier plays. I would have never thought, little me back in 2010, with single family
Right.
rentals doing, these more exotic type of investments. But this is why I think you need an ecosystem around you to kind of pull these best practices, who are the people to invest with, and then, kind of own your own strategy, right? Because in this world, there is no asset allocation mix that people have. It's all over the map on this
Right.
stuff.
Very much customized. And well, I think, what I think of is, you share so many of us in I think the real estate space can be like, when we got started, we had no idea where we would end up. But when you continually do things that are kind of at the edge of your comfort zone that are new and different and maybe not what you were raised doing, that opens the door to more and more like that as you learn and get comfortable with new things.
Yeah, and you have to, right? Because like what got you here isn't going to get you to where you want to be. I mean, I tell people about like, kind of what people I was saying with the real estate world, right? Not to get all doom and gloom or anything like that, but you look at the tailwind, like the tailwinds are not there anymore. You don't have free money anymore. Everything's
Right.
so much damn expensive, right? Taxes. I mean, I had a property in Texas that we bought in 2020. It was like a 300 unit that the taxes were like 150 when we first started. And then now it's over 400. It's
Wow.
ridiculous.
Yeah.
And, you're trying to underwrite new properties under that environment. Of course you try and fight you get a lawyer, you try and fight the taxes, but it's going to be what it's going to be, right? You don't have control over that stuff.
Hmm.
And yeah, again, you bang your head against the wall and you're like, well, what got me here isn't going to get me to where I want to be. So you try and search for alpha. But that said, I still think, we were talking about earlier about the taxes. I still think real estate's a great asset class. I mean, at the end of the day, I take a step back and I'm like, well, what's going to be around 10 years from now? Right? Like, I don't know if the AI thing is going to be a big boom 10 years. I don't even know if it's going to be the next 3 years. Who knows? I have a hint where it's going to be, right? But I mean, I'm not as huge conviction as I do multifamily workforce housing for sure. But at the same time, yeah, I got hurt a lot in 2023. I even forget. I try not to remember. But I had like 90% of my net worth in commercial real estate. It was great on the climb up, and it's what got me here. But yeah, that hurt a lot, and I was not diversified, right? But they always say like to be able to grow your net worth, you need to have somewhat of an insane concentration. So I don't regret anything I did. But going forward, I would like to be a lot more diversified into different asset classes moving forward.
Right. As you maintain that wealth. That makes sense. Well, Lane, you've shared a lot of wisdom from your experience with all the listeners, so thank you for doing so. If people would like to reach out and learn more about opportunities with you or connect further, what's the best way for them to do so?
They can check out my new book, The Wealth Elevator. They'd like a copy, they can go on Amazon and buy it, and maybe they send the receipt to us. Team at The Wealth Elevator will hook them up with the free PDF and MP3 if they're like me and they can't read too well. But yeah, thanks for having me. Appreciate it.
Yeah, well, thank you so much for coming. That is a wrap on today's episode of the Freedom Blueprint. If you got value from this conversation, if you know someone who needs to hear Lane's wisdom, please go ahead and share this episode over with them now, and then join me again next week for another episode of the Freedom Blueprint.